Hello and welcome to another episode of the Opportunity Podcast. I'm your host, Greg, the head of marketing over at Empire Flippers, and today I am speaking with Jessica Rhoads. Jessica, she is a tax wizard, especially when it comes to sales taxes and sales nexus or tax nexus, which, as a lot of my e-commerce and really almost all my entrepreneur friends know, is the absolute nightmare dumpster fire that it is. She helps you make sense of it. So she actually prefers to work with dumpster fire clients, as you'll hear very quickly. So if that's you, you should hit up Jessica. And I think this podcast can help you save a lot of money and potentially a lot of really big headaches. So let's get into it, and I'll see you on the other side. All right, I have Jessica Rhoads here with me. So we were talking a bit about where we live offline. You're in Bangkok, I'm in Saigon, loving the Southeast Asia life. But for everyone that does not know the myth and the legend that is Jessica, why don't you introduce yourself and what are you doing in this whole crazy business?
Yeah, absolutely. My name is Jessica Rhoads. I am a US CPA, but I've lived abroad a long time. Here for the mangoes, but also for the tax strategy of some of those foreign earned income deductions. But I am a dumpster fire accountant. I love cleaning up messes. I love helping people organize their data, get it set up on automation so it's clean. I don't want to spend a lot of time doing work. They don't want to spend a lot of time looking at it, reviewing it. So yeah, it's really about cleaning up messes and then serving them in a nice little package with a bow on it and maybe checking in monthly with them or setting them off and letting them go free then.
I don't think I've ever heard someone so proudly state, I focus on dumpster fires.
It's interesting because some people don't know they have a dumpster fire. Like, oh, I've been really trying to keep my books clean. I did this, this, and this, and I get it. And I'm not going to tell them it's terrible, but a lot of times it's worse than people think because they don't know what they don't know about how messy it is.
I 100% can see that. So back in like 2020, 2021, with all the Amazon FBA, like M&A craziness that was going on, we would get all these FBA people coming to us. And I think this buyer bought like millions from us. He summed it up the best. He was like, I love all these FBA entrepreneurs. They're all so young, making crazy money, and they're all completely broke because their accounting was so messed up. So we would do the vetting, and they would realize, oh, I am not making nearly as much money as I thought.
And I think that's also when you see on Instagram people saying, oh, I made $25,000 this month. I'm like, in gross revenue. What was your cost of goods? Did you pay your sales tax? Who else do you owe? Like, show me the real numbers. So I'll take screenshots on Instagram and zoom in and see if what they're showing on these spreadsheets. So I'm so nosy. So this profession suits me perfectly.
Oh, I am 100% with you on that. Like at a cocktail party, like, oh, I did 7 figures this year. Like, oh yeah, what was your net profit? Like, put the drink down. Stop talking to me.
Yeah.
So talk to me about the different types of taxes that you are like educating entrepreneurs on. Like, what kind of strategies should they be aware of? I'm assuming you deal with only USA, or do you like do abroad?
I mainly focus on USA tax. I think it's interesting that OECD countries kind of all follow the same model. So what's called sales tax in the US is VAT somewhere else, or income tax is generally the same mechanism. So I'd say that the framework is 80% the same, but I'm going to speak to a American tax system, which also a lot of international people have US tax ties. So I think that's applicable. So I'd say there's 4 major tax types. The first one that everyone knows is income tax. Whether you are making money or not, you have to file an income tax return or some sort of informational return. So that one's easy. I think every business owner knows that they owe some sort of income tax if they make a profit and they're filing that. The second one is payroll tax. And this is a big one I think that people overlook as maybe not a tax type they should be hyper focused on, especially for entrepreneurs. I've seen mess up payroll tax where they hire someone, they set up a payroll, they don't get the right state tax IDs for unemployment tax or withholding tax. Or what I've seen some entrepreneurs do is you withhold, let's say I pay someone $1,000 a month, I withhold $300 in tax. You're supposed to remit that money immediately to the government, but I have cash flow issues. So I say I'm going to remit it later. That bad news bears, penalties. So payroll tax you should pay attention to. The third one is, and what we're going to talk about today, is sales and use tax. So everyone knows sales tax. When you buy something, you get charged sales tax. The flip side of that is something called use tax. Actually, have you heard of use tax before, Greg?
No, I don't believe I have. I mean, I have a lot of like tax wizardry friends, so I'm sure they've told me this, but my memory is also very vacuous.
Yeah. Yeah. So use tax says that if the vendor did not charge you sales tax, you are responsible on your personal income tax return for saying, hey, Greg didn't charge me sales tax. I'm going to self-assess use tax. So it's the flip side of the sales tax, which is kind of an interesting piece that we can talk about
From the
later.
consumer side.
Yes, yeah. So you owe
Wow.
sales tax whether someone charges it to you or you self-assess technically. So when you file your state income tax return personally, you'll always see that question. Like TurboTax will ask you, did you buy anything and not pay tax in your state?
Really? Wow. And so then they use that to go after the business that you bought the product from, or?
They can, yes, because then the states have requirements that say, hey, once you've met a certain threshold, you have to start charging sales tax. So they basically are coming at it from the consumer side and the vendor side to make sure that people are paying in to the state.
Amazing.
And then the fourth tax I would say is there's four buckets to keep it simple would be kind of gross receipts tax, property tax, franchise tax, a whole miscellaneous bucket of we'll focus on sales and use tax today.
So I mean, that's interesting. I don't think I have heard of that actually. I would assume most consumers are like me, where they have no idea what they paid sales tax on for the most part throughout the year. But moving back to the entrepreneur side, why should sales tax be on the entrepreneur's radar, especially when they're thinking about selling their business? Like, how does this affect the actual exit for them?
Yeah. So let's say I want to buy someone's business at a high level. I'm not only buying the exciting stuff, the sexy stuff, revenue, gross profit, all the marketing, the Instagram followers. I am buying your liabilities. I am buying your tax ID. So that tax ID has history. And if you've never filed a sales and use tax return as let's say a software company, the statute of limitations never starts. And that's across all, I would say mostly tax jurisdictions for all tax types. If you don't file the return, the clock never starts ticking. So I think a lot of entrepreneurs are just like, oh, it'll be fine. Like I'll start filing later when I get bigger. Once I make $1 million, then I'll start paying. No, they can go back forever and start looking at you until you file that. So I think what I've seen is someone buys a business. They don't check the tax liabilities. They don't check that they've been filing income tax returns, sales tax returns. Most people are filing income tax returns. Sales tax is where I see most business owners just like, don't ask, don't tell, not my
Yeah, a
problem.
lot of my e-commerce friends just have clearly given up on even trying.
They think, oh, I'm too small scale. But in a lot of states, the general rule is 100 or 200 transactions. So if you're selling software for $5 a month, 12 invoices, like you are going to hit that transaction volume, not necessarily the revenue volume. There's a lot of ways, and we'll talk about this later, two ways to trigger it. So you've never charged sales tax. I buy your business. A year later, let's say New York State, I hire an employee in New York State with that tax ID. And all of a sudden, New York State is like, I haven't seen this tax ID before. Have they ever paid sales tax under this tax ID? They don't find it. So they just send a letter saying, hey, do you charge, what's your product? Are you charging sales tax? And then the statute of limitations is for the whole time that company was selling.
So is that true with even asset purchase agreements where you're not taking over the entity, but rather taking the assets into your own entity?
That's a good question. If you're going to shut the tax ID down of that old one, I would imagine, but I would have to get back to you on that because it's tied to the tax ID, not necessarily the assets. So that may be a way, but I don't know enough at this point to comment on that.
This is why my listeners listen to me, to learn possibly dodgy ways to avoid taxes.
I guess should also caveat, this is not specific tax advice. We are just having fun and learning today.
I want to also caveat Jessica's giving you legal and financial advice. Just opening up the lawsuits over here. But yeah, that was my general understanding. Like at Empire Flippers, we do a lot of APAs, so asset purchase agreements, right? Mm-hmm. Versus stock sales. With stock sales, I know, like, yeah, of course, you take over the liability. That's part of the deal. So for example, let's say an entrepreneur, not tax related, but this is something that happens now and again. Say they did like revenue-based financing on their e-commerce store, or took out some kind of like inventory loan, working capital loan. So they might have like $100,000 on it, they'll have to pay off. They sell their business for $600,000. They take that $100,000 of the $600,000 to pay that off. The new buyer has no relation to this debt whatsoever because that's a liability they don't inherit. So I'd assume that would also be true with taxes, but I don't know.
If they're looking at the tax ID, as long as that old tax ID is getting shut down, then that state is not going to inquire on it as long as it's not still being used. And I'd assume the seller then shuts down that tax ID. Is that normally what you see? Once they sell the assets, they shut that old LLC down or C Corp?
So it can be really messy with a lot of these smaller entrepreneurs, as you probably know, the dumpster fires, right? Because like one of my friends, he's selling a small agency right now. I was like, oh, do you have like a QuickBooks, like line by line breakdown that you can give to the buyer? He's like, no, because I have too many other businesses in this QuickBooks account. I'm like, okay. Like, can you like isolate it? Because like the buyer's probably going to want to see that.
Yeah.
So like, you know, it goes, you just like put everything in like one big bucket. Like we'll figure the spaghetti mess out later. And then later comes like, oh, now it's way worse because I've let this go for like half a decade.
Yeah, man. And buyers should be, I know buyers get excited too, and they should be looking, at least make sure if they're going to assume the assets that it's not, there's not such a big like you haven't been selling millions into the really big states. That's at least like a gut check just to make sure. But I think asset purchase would be a better way. Roll it in under your new your existing tax ID.
Yeah, I think the advantages of an asset purchase almost always outweighs the stock sale. There are advantages for stock sale too, and in some cases you have to do it. I think UK in particular, it's like more tax beneficial to do a stock sale, so buyers can get in on a lower price. But then you do assume the liability, so yeah, you got to be careful with everything. So many people think when they think of sales tax, usually we're thinking of a physical product point of view, right? Like at the gas station or selling like an e-com product. But how is sales tax applied to like software and like SaaS and apps? You mentioned SaaS earlier. So is it different? Is it the same?
So I'm sure you recall in the late 90s, early 2000s, you'd walk into an Office Depot or a Staples and you'd see a giant tower of CD-ROMs, like The Sims, Encyclopedia Britannica, Microsoft Office, and you picked up that box with the CD and you checked out and they charged sales tax on that. So when software entered the tax code, that's how it was codified, still as a tangible good. And then, the internet comes around, people start selling things by way of just information transfers online. And for a while, it skirted the rules of a tangible physical sales tax because states were like, well, it's being transferred electronically. There's no physical good. Some states, it's about 50-50 right now, still look at it as if it's being transferred. Like you could have transferred that on a CD-ROM and sent it to someone's house. So they still look at it that way. So software is not this intangible that I think a lot of people say, oh, it's software as a service. Some states look at it like that. A lot of them are still seeing it as the physical CD.
I wonder if that's why WeWork called themselves a SaaS, space as a service. I always thought that tickled me. Like, we're a SaaS company. You're clearly not.
That one also, maybe a tax tangent. There's a commercial rent tax in New York City that if you have any lease on rent, you basically pay a 6% kind of sales tax on lease. And WeWork is silent on this issue, but New York State taxes your WeWork lease. And I'm like, this is not a real commercial lease. This is a service, but the tax department says, prove me wrong. And WeWork is silent on it as far as. All right, guys.
There's I don't know if they have them in Bangkok. They have them here in Saigon. So it always reminds me of WeWork. Because like WeWork, obviously they were going for the SaaS thing to try to get the overvaluation, at least in my view. But there is a convenience store here called I think it's G25 Lifestyle Platform.
Okay.
And it's just like a 7-Eleven, basically. And it made me think, like, I wonder if the person that raised money to start this convenience store named it this, so the investors thought they were investing in like a tech platform. So they could get like better rates, and so the investor just never looked into it.
People are so creative.
Anyhow. So how do business owners figure out like what their products are taxed at? Like, if I have a software, am I getting charged like a CD-ROM? Is it a service? Like, when do these different things start triggering across different products?
Yeah. So every state is different. So it's important to use a tax software. And the first step would be figuring out what kind of product you're actually selling. So questions that people should be able to answer is, does the customer take control of your software, or can they further edit it and tweak it on their own, or are they getting some sort of canned? Have you heard this term canned before?
I mean, I know what canned means, like boilerplate, basically.
Yeah, absolutely. If someone else can buy the exact same software and you're just changing their logo in the corner, that is canned software. And that is, in most states' views, going to be a piece of a CD-ROM that you could have copied and just made back multiple copies of. So can you take control? Who hosts it? Is it hosted on the customer server, or do you continue to host it? Is there ongoing support for the software, or do you just release it to them and that's it? No more pushes. Are you servicing it in any way? Is there some sort of service implementation portion that you would want to know the value of that versus the software that you're selling? And then also if you're selling just B2B or also B2C, because certain states will tax it differently depending on who you're selling to. So if you can answer all these questions, then I recommend going to some of the big tax softwares or Avalara, TaxJar. They have these big Excel downloads and you can filter by item type, like software, and start reading the codes and then pick the code, the item code that best matches your business. And then that code, once you put it into the software, is going to do the rest for you. It's going to look up all the states and tell you where you've triggered.
Interesting. And that trigger is based on the amount of customers. That's kind of what you were hinting at earlier.
So there's nexus. So once you figured out the product taxability, you need to figure out if your product is taxable in that state. Are you even responsible for collecting and remitting sales tax? And that's normally based on a 2-factor test. One is either transaction volume. Generally, it's 100 to 200 transactions in the last year. So softwares with a low selling price have to be careful about that one. Or it's about $100 to $200,000 in sales in the last year. So when I talk to business owners, they say, oh, I don't think I sold 200K into New York, but did you potentially have that transaction volume? And every state is different and they're constantly changing it to basically force everybody to collect and remit.
So only sell to 99 customers per year in each state. that's how you heard it here first.
Literally 50 different states, and they're constantly updating. And so honestly, when in doubt, I think best practice is if you know your product is taxable in that state, don't wait to trigger it. Just set it up, start collecting, because we go back to the use tax. Either way, the customer in that state, the buyer, is responsible, whether they're going to admit it on use tax or not, but you should not feel bad about collecting sales tax before triggering Nexus, because just set it up and let it run and be done with it.
Like you have to do it, right? Like it's going to come back and bite you if you don't do it, right? So I want to double click on this Nexus thing. So this is kind of what I was hinting at. A lot of my e-commerce friends have just given up completely, and it usually deals with Nexus. Yep. So maybe before I go into this next question, to just describe what sales tax nexus is, because a lot of my audience, they might be young, making all that revenue, and have no idea it's about to go away.
Nexus is a little bit of a dirty word in accounting. Nexus is
in M&A as well.
Oh, you have Nexus. I'm like, sometimes it's good if you want a long-term sticky relationship, but other times you're like, ooh, I don't want to trigger Nexus there. So Nexus is when you have enough ties to a tax jurisdiction, and this will happen because of sales. Employees is a big one. People think, oh, I can just have one remote employee in Michigan. Doesn't matter. No, Michigan cares. Michigan says you now have Nexus. You have an obligation to file a return. So sales, employees, property, and also time spent in a place. Even if you're not generating revenue, you're working remotely, time can trigger tax Nexus. So it forces a filing requirement in a tax jurisdiction.
So from an employee perspective, like EF, we have this problem. Like in the beginning, we were just going ham and getting every Nexus in every state. So we have Nexus in Alaska because of me, but I'm in Vietnam. And I'm like tax-wise, I'm domiciled in Vietnam. So, you mentioned the FEIEs thing earlier, that you guys digital nomads, right? Like domicile is like the next level of that, which is even better. It's like basically the same, only I can go to America for like 6 months now. But yeah, so we have Nexus in Alaska thanks to good old Uncle Greg over here.
And once you trigger it, it's very hard to shut it down. The state does not want to shut your account down unless you have a really good reason. So it's just kind of open forever, and you have to keep filing potentially a zero return.
Oh yeah, it's easy to start paying taxes. It's hard to stop. So it's like a predatory subscription.
Right? Like a SaaS pollution with tax. A lot of states, even though you don't have a taxable product, sometimes they say you've triggered Nexus. We want you to file just zero returns. Oh, I've sold 200,000, none is taxable. So it's just informational. But if you don't do it, failure to file, there's a penalty there. So there may be no tax due, but you still have to file.
Amazing. So I assume there must be software here, because like e-commerce, the reason why my e-commerce friends give up is exactly what you're saying. Like the rules are changing all the time. Like even when they want to do it, like, be above board, it's just so hard. So like, how does someone manage to even do this?
Yeah. So there are tax softwares. Avalara, I have a love-hate relationship with. TaxJar, I've not used, but they all work in the same way in that They are looking at your invoice registrar, which is important to have, like we talked about your friend with the messy QuickBooks, important to have a system that can generate invoices, and it's the ship to address. We haven't touched on this yet, but the ship to address is what is triggering sales tax. So you really should care where your customers are. So if nothing else, the most basic thing a business owner can do is download their sales every month and filter by ship to address, which I imagine they're getting on the credit card if they're charging that way, or on an invoice, and just know where your sales are going. But then I would recommend setting up Avalara. Also, Shopify and Stripe will notify you because they're also tracking those ship to addresses, and they will flag it for you. So I think set up the tax software. You can use an accounting consultant to do it, Avalara. I would use someone external to Avalara to help you integrate it that really looks at your business and is not just trying to sell you, or TaxJar. And then once you set it up, it truly does. It's like the set it and forget it rotisserie chicken. It will just run, and they will be pushing software updates. It's good to check in maybe twice a year, but the software will do it all for you.
Interesting. So I want to backtrack a little bit because we were talking about software, how sometimes it's taxed as kind of like a physical product. Is that true with services like, say, marketing agencies as well?
Fun fact. So it depends in certain states how the service is delivered. Is it human to human interaction? Are you delivering PowerPoints over email? And in certain states, Washington being one of them, if you're delivering a service, but you are relying on software to help you deliver that service, they are still trying to tax that. And you have to prove that more than 50% of the effort came from humans and not on any sort of reliance on software. So when I have customers who have their whole website saying they're AI, data-driven automation, and then they're telling Washington State it's all human effort, it doesn't line up.
They're just following the Amazon model when they said the AI checkout, right? But it was actually like dudes in India. Like, this is just a marketing thing. We don't actually have any AI.
Generally, services are non-taxable, but it depends on the states. And as you know, certain states don't have income tax. I don't know. Does Alaska have income tax? I feel like they don't.
I don't believe so.
I don't think they
we
do.
don't have any sales tax either.
So they're getting taxes. States get their revenue from either income tax, sales tax, or road tax. So Florida has some of the highest road tollway tickets in the world because they don't charge it. So like a state like Washington that doesn't have income tax, they're going to go really hard on sales tax. So they may tax services as well.
Okay. Yeah, Alaska gets a lot of its tax revenue from renting land to the oil companies and mining companies. So we kind of subsidize it in that way.
I love that.
Yeah. Okay, that's interesting. So the Alaska thing actually makes me want to ask you another question here. So I always hear, and like our company is a Delaware company. A lot of people set up Delaware companies. Other people do Montana, Nevada currently is like a bit of a hype for it as well. But if you're paying sales tax in excess, like what is the benefit of being set up in these states? Or like maybe walk us through, like, does it matter as much as people think? Like, would you recommend like these 3 states, or, what are your thoughts on it?
Actually, it's a great question. So I think people get a little bit confused between Secretary of State and taxes. So when you register your business in Delaware, say a Delaware C Corp or Delaware LLC, you are registering with the Secretary of State, which is not a tax agency. You are saying that when I do business, my business is recognized under the laws of Delaware. And a lot of times you do that because in your contract, you can say, if there's litigation, we're going to fight this out in Delaware. Delaware is very pro-corporation. So that's why people have always done Delaware. So having a Secretary of State registration in Delaware has nothing to do with your responsibility to collect sales tax in all the other states. It's just legal protection for your business under certain state laws. And Wyoming is good because they don't disclose who owns the LLC. So it's really private. And then, so I've seen more people do Wyoming, and Delaware is good because they often side with the corporation when there's litigation.
We had a buyer. We had to verify his address for his to verify his liquidity, right? And he had one of these scammy Wyoming addresses that all the crypto scammers use. And it was like popping up, like a bit of a red flag.
Yeah. Also, you brought up a good point though. If you are doing business so your home registration is Delaware. If you are doing enough business in another state, the Secretary of State wants you to register there as a foreign entity. They call it foreign when it's not your initial registration. So if you have employees, let's say again in Michigan may want you to also register with the SOS, Secretary of State. So they just have more information if you're doing enough business in that state.
Interesting. Okay. So what about like Nevada? Does Nevada have any pros? Like why are people going into Nevada for their LLCs?
I'm going to guess it's the minimum tax right now. As if you're an LLC in Delaware, I think you pay $300 a year, which is a bit pricey. There are some states that are really cheap, like $50 a year. My guess is it's a lower tax in Nevada, but I'm not sure specifically.
I mean, they kind of have the sinning version of Alaska where all their taxes are subsidized by gamblers.
Right.
So they got that going on. Okay, that's interesting. That makes sense. Like from a real estate perspective, you're always thinking about like pro landlord states and cities as well. So that does make sense to me. When it comes to the sales tax stuff, and I guess tax in general, obviously every state is a bit different. Where is like particularly aggressive or just like needlessly complex states? I assume I know the answer, but
Washington State is. To be fair, it's interesting because when you can talk to a state really easily, when you can get them on chat and email, and they're super excellent customer service, you know it's because they are making so much money. So Washington State, they're aggressive, lovely customer service, but I think, yeah, the one where they push back on the more than 50% on services, I've never seen that. New York would be second because I think New York is good about they must be analyzing other data to figure out who owes tax. So I said about that commercial real estate tax, they're somehow getting eyes on all the new leases. So they're using outside data to cross-reference or, oh, Joe signed up for a withholding tax account because he has one employee. What other taxes aren't he paying? So some states are getting better at, and I think when AI, the scary thing is AI with sales tax. States are going to start looking at all these huge databases and cross-referencing tax registrations, and stuff's just going to start popping out. And they're just sending out notices. That's what I've noticed. And then all they have to do is just send a notice and say, do you think you owe sales tax? And then it's your responsibility now to respond and say yes or no. Also,
maybe catch me.
New Jersey, New Jersey's aggressive. Luckily, California does not tax SaaS because otherwise they are an aggressive state.
Really? They don't
At
tax
this point,
SaaS?
for canned SaaS at this point, it is not currently triggering taxation.
Really? That was like, I was surprised you said Washington because in my head, I would think California would be number one and then New York number two. So I was surprised Washington beat out New York.
Oh, also Chicago. So Illinois does not tax SaaS traditionally. Chicago does to Chicago customers. So you need a local tax ID for Chicago, and it's an extra feature in Avalara to be able to file Chicago returns.
The Chicago is wild. I mean, Illinois is pretty wild in taxes as well. That's surprising me about California with the SaaS stuff. I guess that is probably one reason why Silicon Valley stays in Silicon Valley. But
well, California is making that money off income tax, so they don't need to go as
right.
crazy on sales tax potentially.
Yeah, that does make sense. So once a business determines they have Nexus, like what is the system to stay compliant with this? Is it just as simple as getting someone external to Alivar to set that up for you or TextJar or whatever, and then it's just whatever? Or like is this more manual work that the entrepreneur really needs to be paying attention to?
I don't think, especially because entrepreneurs should focus on what they do best, hiring
Avoiding
someone
taxes.
to initiate. Oh my God. La, 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 la. You're allowed to avoid them. You're not allowed to evade them. I think that's a key point. Avoid taxes in your best, but don't evade them.
No evading, maybe some dodging.
Some avoid.
Joking. Please, this
I'm
is not
emotionally
legal.
avoidant and tax avoidant. So I would hire potentially someone to analyze your product for the first time and get a good write-up. What is the product? Have a tax person look exactly what you're selling and document what you're selling. And then you can use that information to set up the software. Then another piece of this would be looking at your historic sales. I would go back. If you have all the data, go back as many years as you can and just figure out, did you trigger the filing requirement a few years ago? And if so, what should you have paid to these states potentially in sales tax? Because that would be the point when you want to do a VDA, a voluntary disclosure agreement, where you go to the state and say, I am sorry, I should have been filing this. I owe you $25,000 in back sales tax. And most states are good about just charging you that money and waiving the penalties and interest, which are so high. But if you don't do that, if you just say, hey, I'm going to start collecting a sales tax today, the past is the past, and later that state comes back and says, hey, you just started in 2025. What about your sales in 23 and 24? that's when they potentially will stick you with the P&I, the penalties and interest, because you did not VDA. So VDAs, I think it's scary to do. People don't want to admit it, but states want you to get in the system. They want you to pay in. They don't want you to pay P&I. They just want to get you set up. So I would recommend a VDA if you realize you should have been paying in a material amount.
Are you saying VDA or
VDA, voluntary disclosure agreement?
Okay, that was my next question, to talk about what VDAs are. But I actually had another question made me think of before we talk more about VDAs. So back to like the nexus thing. Let's say I'm a marketing agency or a SaaS company, e-commerce, whatever, right? And I'm selling primarily to America, but I have a large amount of money coming in from, foreign countries. So UK, Germany, maybe I'm selling in Asia with some of my services. How does that fit into the whole tax scheme here? Is it just basically just your normal taxes because there's no USA nexus over there? I mean, obviously, you got to deal with their taxes, but how does USA respond to that?
So from a US tax perspective, if you have foreign income, from an income tax, you're apportioning your revenue generally. Okay, so for income tax, states have different rules again. Either it's ship to address, which they call marketplace, or cost of performance, where you spent the revenue or the time generating the service. So depending on what the state does. So if the state is marketplace and you're selling, let's say, to India, the state would not tax that revenue because they're sourcing revenue based on marketplace rules, saying if you didn't sell into our state, we're not considering that taxable revenue. So federally, it's all taxable, of course, with the IRS. But on a state-by-state basis, it depends on if it's cost of performance or marketplace. I've seen more states go to marketplace income tax revenue sourcing. So the foreign sales aren't going to be taxed on the state level in some cases, which is nice.
Okay, cool. Yeah, so I could see that being like a nice workaround for a marketing agency where, maybe they just found you through the internet and you suddenly have a contract. But in terms of like e-commerce, so if I'm selling my physical product in UK and USA, so I'm paying UK taxes, I'd assume, on my products I'm selling there. But does that also mean I'm basically paying double taxes to America as well because I'm an American company selling into UK? Or can I just pay the UK taxes and not the American taxes for that segment?
So if you've triggered some sort of income tax nexus in the UK, there are so many double tax treaties with the US that say we will credit the amount of foreign tax you have paid. So, I mean, the US has negotiated tons of them. There's still some random countries that don't have the double tax agreement, but generally there is one. So you would not get double taxed. The US would say, here's the tax we think you owe calculated on the US system. We'll allow any credits that you've paid to other countries. And then we're just going to charge you the difference if it's less. Or if it's more, then it's, sorry, Uncle Sam's not going to give you a credit back for that. Okay. Generally, double taxation agreements on an income tax perspective are helpful.
You just made me, so in Vietnam, there you have Uncle Ho, right? Ho Chi Minh. And I was telling my wife, she's Vietnamese, about Uncle Sam. And she's like, oh, yeah, was he like a revolutionary leader in America? Like, no, he sold like sausages to soldiers. It just became like, that's like well, we don't know for sure, but like that's kind of like one of the origins is like Uncle Sam was this dude who somehow always had meat that he could sell to the soldiers, and the soldiers like loved him. Like, it's Uncle Sam.
I don't know how we got that. And I love Daddy Trump, saying Daddy Trump and Uncle Sam. So crazy.
I love it. All right, cool. So let's talk a little bit about VDA. So voluntary. What does it stand for? Voluntary what?
Voluntary disclosure arrangement, or VDP, voluntary disclosure program.
Cool. So, I mean, it sounds like it's better to always be proactive here. And that makes total sense to me. Like, in general, I don't think like the government IRS is out to like screw you intentionally. Like, so if you come to them like with, honestly about it, like, hey, this messed up, let's fix it. They're like, okay, cool, let's work together. But is there any situation where you don't want to do that? Like, where is the VDA always the right move? Or is there times where like maybe you shouldn't be doing this?
There is the cost of compliance. If you're hiring an outsourced accountant and they're going to charge you hundreds of dollars an hour to do this program, but you only owed $800 in sales tax, and the penalties and interest on that could be, maybe double that. Let's say your total exposure is around $2,000 with the tax amount due and penalties and interest. I guess interest could keep accruing forever if the state really wanted to come back. So if it's some small amount and the cost of compliance is more, you could potentially avoid it. If you're trying to sell in the future and you have a sophisticated institutional buyer who is going to check everything, then that's when you could potentially tank a deal if your books aren't clean, your taxes aren't sorted. So I think it's scary to do a VDA. People think they're going to get locked up, but states even have automatic web forms now where you write, you don't even have to do a special legal thing. Like the template's there, you fill it out, you give them the data, they send you the bill, you pay it. And then with VDAs also, I've gone back to those customers and said, hey, Washington State has audited us. You owe us sales tax, or show us where you paid the use tax. And then they want to say that you're not trying to scare them, but you are kind of scaring them and saying, hey, you were on the hook for this. Did you pay it? And if sometimes they'll ignore you, and that's honestly the best strategy. If you get one of these emails like you owe back tax, just maybe ignore that. But if you're the seller, you're paying
Not
it.
legal.
Well, if someone emails me and says, hey, you bought software from us, you owe us $15. I mean, they have no way to really come after you, but sorry, getting back to focusing on the business. You can then contact your customers and say, hey, you should have paid the sales tax. We are now paying it on your behalf to the state. Can you show us where you self-assess use tax? And if not, we're going to send you an invoice for the sales tax portion. I would say 80% of customers are good about it. They know they should have been charged sales tax. They'll pay you. I've even seen big companies pay up on it. So after you VDA, you're not totally out of pocket. You have a chance to go back to customers.
Okay, that makes sense. I'd assume also, like, if you have a professional accountant or a tax person working with you already with the company, that they can just do this VDA stuff for you as part of that. So like that makes sense to me. Before we get into like kind of one of my final questions here, before we move into rapid fire section, I do have another question. So I've often heard that it's better to pay your taxes quarterly as a business owner versus annually. Like, walk me through that. Like, what are your thoughts on that? How should an entrepreneur kind of forecast and, pay their taxes? Should they do it 4 times a year? Should they do it once, twice? What's your thoughts?
So it's important to distinguish between the type of tax. So when you say paying in quarterly, you're referring to an income tax, where I just want to clarify that sales tax is generally paid in monthly or quarterly. I would say monthly is generally what the states want to charge you. You collect in the month, you remit it within 2 weeks at the close of the month. But
really? You're remitting it every month?
Oh, sales tax. Yeah. So they call it circle and pay. You're collecting from the customer and then just turning around and giving it to the state. So you're just like passing through.
Interesting.
You're just the middleman on the sales tax. It is not your money. And so if you're collecting that from the customer, the state doesn't want you sitting on that sales tax revenue just in your bank account. So they want you to remit it pretty quickly. So talking about business owners paying in quarterly taxes, Uncle Sam every year looks at how much you owe, and I'm going to say he, because he is like Uncle Sam is a he in my mind. They want to be paid quarterly because they say, hey, don't wait until the end of the year when you were earning this income through the year, but you weren't paying me taxes. So there's a safe harbor where if you make less than 150,000 US dollars, you can pay in 90% of the previous year's taxes. And generally, if you've paid that in, there won't be penalties. So you want to make sure you're paying in enough over the year based on sort of your last year's income. So you can just Google safe harbor underpayment penalty, and there's usually a calculator like how much did you owe in federal tax last year? This is what you need to pay in to avoid an underpayment penalty. I do think business owners should be looking at their net profit every quarter and saying, what's 20% tax on this? What's 15% tax on this? And then sending money to the government. They never overpay, especially I'm a big fan of high yield savings accounts. Do not overpay the government. Keep that money in a high yield savings account if you can, so it's making money. And the last moment that you owe them the money, give them the money. Like, that's the most efficient way to do it.
Not overpaying Uncle Sam? What kind of patriot are you?
People, they love getting a refund. And so they pay in all this tax and they're like, oh, I got a $5,000 refund. And I'm like, you're not very smart, because you could have that $5,000 and you could have put in a high yield savings account and made like $200.
Right. Yeah, if you get a refund, it means you overpaid. Yeah.
Okay. Interest-free loan, excuse me.
So my final question for you before we move into the rapid fire section. What's a major misconception you see founders have about sales tax that, come back, bite them later during an exit or an audit?
I think people think they're too small, or they're not making enough money, that the state doesn't care about them. And
state always cares.
They won't find me. Yeah, I'm not big enough. it's too complicated. None of my other friends are collecting sales tax. I do want to point out if you are selling through Amazon or one of these big other marketplaces, there is a marketplace facilitator rule where they have to collect and remit it on your behalf. So a lot of this doesn't apply to people who are selling through marketplaces, which is really nice that that's already sorted. But for these software companies, they just every time when I see a vendor invoice from a software company and there's no sales tax on it, I'm like, oh, buddy, should have charged me now. I would have paid it.
I mean, that can be like, well, I don't know. I would think it could be a sticking point if someone's buying like, say a software from us and say like we sold a Danish, I think it was a Danish software like a year or two ago. And that was to an American guy. So now I'd assume he must have sales tax that didn't exist before the acquisition. So like that could like change a bit of the calculus of your actual profit of the thing you buy. Like maybe that seller was doing everything perfectly, but now you just inherit this thing that's going to have this new tax burden because your LLC is, United States, right?
If you're selling into the US, it doesn't matter if you're not registered there. The state is going to say you have an obligation because you are selling enough transactions into that state.
Okay, so they would go after the Danish software anyways.
They would, yeah. Say like,
Uncle Sam is so good with his global reach.
Well, that's why AI is kind of freaking me out in terms of tax compliance, because once they figure it out, there's going to be notices flying out to everyone.
Oh, yeah, I bet. I was just at a Perry Marshall event. So I spoke at an event in Chicago a few months ago, and there was a tax wizard on stage, and she was talking about how, like, in the past, she was like, one of the big benefits of hiring her was that when she meets with the IRS, she knows the tax code like way better than they do. And like, she knows like all the tricks, all the loopholes, can bring the receipts. But she's saying now with AI, like a lot of the IRS people are starting to use AI. Now they're just as good as her because now they have the AI. So she's like, okay, well, some of my value add is going away here.
Yeah, I've found that AI messes up the tax stuff a lot. And then I'll argue with ChatGPT. Even prepping for this call, I just wanted to double check some stuff and have it make me make a matrix. And it just left off New York on the tax matrix. And I was like, how? And I was like, hey, ChatGPT, what about New York? Oh, my bad. I'm like, what? I can't trust you anymore.
Oh, yeah. ChatGPT is the most confident liar in the history of the world. Oh, I mean, Claude does it too. Like, I put all this data into Claude to try to like analyze like what are the trends of this thing, and it just completely hallucinated. Like, none of the data was right. Like, where are you even getting this? And he's like, oh, sorry. Are you like drunk, Claude? What's going on? But anyhow, all right. We're in the rapid fire section, so I'm going to ask you 3 quick questions. You give me 3 quick answers. Are you ready?
Yep.
All right, let's do it. What are the best hidden growth opportunities in your view when it comes to lowering a business's tax burden?
Plan early. Don't be reactionary. Spend the money up front. It'll save you for sure.
100%. Don't be penny wise and pound foolish, as they say, right? I'm actually going through that with a buddy of mine. He has a big agency that he never had an accounting system with, and he's like worried about like paying like a few $1,000s for his accountant to do it. Like, dude, like you're never going to sell your business without this. Yes, you're paying it.
Sorry. My favorite is when people are so rich and then they don't want to pay about taxes. And I'm like, oh, boo-hoo, you're so rich. So high.
Right. All right, second question. What tools or resources can people use to help them maintain or remain tax compliant?
Like getting the software. Don't try to do this manually. Don't try to have someone file it manually. Just pay for the software to do it. And once it's set up, you're just going to sleep better at night.
And I would argue what you said earlier they should do too is like have someone who knows the stuff set it up. Because like I try to use QuickBooks and I'm a bit of a tech idiot despite my industry and I messed it up. My tax guy like, what are you doing? Like, I have no idea, man. Maybe can you like save my dumpster fire? So yeah, entrepreneurs
like
are not
me.
often the best with it.
You want me to update my Wix website? I cannot do it. It'll take me 6 hours. So I hire people to help me. Please hire people to help you.
Yeah, 100%. It's not worth your time to dig into this as much as you think. So, all right, my final question for you, probably the hardest question. If you do not have a good answer, we cannot publish this podcast. So no pressure. What has been your funniest moment in working in the online business world and the tax compliance world?
There's a tax called the ballpark tax in Washington, D.C. And I think ballpark, oh, it must be an estimated tax or something. No, it's literally to fund the ballpark. And I misunderstood that for a while. It's like, oh, the ballpark tax. No.
So you just see it on people's P&Ls, like their ballpark
Yeah,
tax
or
that
like,
they owe.
oh, we need to file the ballpark tax, but we're already paying estimated taxes. We must be okay. No, it's literally a tax to fund the ballpark. And it's on gross receipts, not profit. So even if you're a business in DC and you are losing money, you could potentially still owe thousands of dollars to fund the Washington Nationals.
Uncle Sam's economics, man.
I love it.
Unfallible, infallible.
Yeah.
Awesome. Well, this has been an absolute pleasure. I know taxes can be a bit of a dry conversation, but I enjoyed this conversation a lot. I personally, from my perspective, and really anyone in my audience, if they're looking to buy and sell businesses, I think taxes are like a massive hack, at least the American tax code, to know because it's so complicated.
Yeah.
There's so many different loopholes that you can take to advantage, and this is just like scratching the surface, right? But if someone wanted to connect with you, Jessica, and like pick your brain, maybe look at what kind of services you offer, where should they connect with you on?
Yeah. Jessicanomics.com. So
All
yeah,
right.
always happy to talk to people, just learn about their business, hear what they're doing. Yeah. I'm nosy. I love it.
Let me look at your books.
Will you share me your QuickBooks?
Awesome. Well, I really appreciate this conversation. It was an absolute pleasure. We'll put the link to your site in the show notes as well. So if anyone wants to pick Jessica's brain, go ahead and check that out. Thanks for coming on, Jessica.
Thank you.
There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.